Well, joining me now, Scott Chronert, U.S. equity strategist at Citi. Scott, it's always great to speak with you. And let's start right there, especially on a day where the market seems to be pulling back from session lows here to do an about face. You like the small and mid caps. Why?
Well, Morgan, I think there's a couple of things at work here. What we're arguing is that as we go into the end of this year, the market is increasingly paying for 26 earnings growth expectations. We're certainly going to get follow through out of the Mag 7 AI affected part of the market in the next year. I think that's pretty visible from our perch. But incrementally, we think the setup here begins to get more constructive as you go down cap. If you look at consensus expectations right now, they are for essentially the small mid cap part of the market going from low single digit earnings growth this year to low double digit next year. And then importantly, the teaser here, to your point, is as we've gone through the Q3 reporting period, those companies in the SMID space that have delivered what we call a beat and raise plus, i.e. they've raised Q4 and 2026 guidance, have seen an outperformance dynamic even above that of the S&P 500. So the bottom line here is that we think the focus here is very clearly shifting to 26 earnings growth setups. Yes, large cap is going to have that, but the catch up fundamentally it actually has a bit more of a down cap bias to it.
Interesting. What spurs that earnings growth in these smaller stocks? What is, I guess, propelling the catch up here?
Well, first the compares. You're coming off of essentially 2 years of down earnings. So the small mid cap space has been in its own version of earnings recession, which probably reflects the more traditional underlying macro environment where that Mag 7 AI component has been very differentiated. So now we're coming through a year of a lot of administration policy noise, which to a certain degree should be behind us as we go into 26, at least on a relative basis. We potentially get another Fed rate cut or two. So from a rate sensitive component, you begin to kick in. All told, what you're going to get with U.S. SMID is a higher level of economic sensitivity versus large cap. And in so doing, as we go through this period of policy indigestion leading to the other side of that, with some help from the Fed, the setup economically should at the margin be pretty good for the small mid-cap space.
Okay. That being said, let's segue here to some of the bigger cap companies. There's obviously a lot of scrutiny now on the AI trade. What are your thoughts?
So I think when we look at the spending dynamics under the surface for the AI trade, I think what we're talking about is two discussion points: persistence of the spend and the tailwind. And that persistence has pretty good line of sight for CapEx spending improvement out to the end of the decade. Then there's magnitude of spend, right? And this is where you're going to get into how quickly do you spend, how quickly can you spend, and how quickly can you, for investors, justify a return on that spending. What that's going to lead to is ongoing bouts of volatility. So the way we're thinking about this is there's no question the AI tailwind should persist next year. We want to have exposure to it, but we have to allow that it probably gets increasingly idiosyncratic from a stock selection perspective. So we're still on page with overweights in semis and software. But, for example, we had lowered comm services, the media component of it, to a market weight after a 2.5-year overweight. So we're getting a little bit more focused on where within the AI playbook we want to be. But what we still have ahead of us is all of the other companies that aren't directly associated with AI that are beginning to implement AI processes in their workflows. Ultimately, what that does in terms of our structural bull case for U.S. equities sets us up longer term for where we get higher level of productivity. Presumably, we see higher margin structures, higher profitability, lesser earnings volatility, and through a cycle, we think investors end up paying a higher valuation for that.